gift annuity, contractual arrangement between you and the organization, okay? When you start getting into a unit trust or a charitable remainder trust, a lot of things are happening here. But let me conceptually try to take that gifting scenario. You didn't want to give it to me outright. For whatever reason, we weren't able to negotiate something with the bargain sale. Then I'm going to come to, what is your name, sir? What is your name? Huh?
Saeed.
Saeed, let me ask you something. What about, what if there was a way where we could take that property, and I know it's $5 million, and your cost basis is $500,000, and if you were to sell it, you would get clobbered with capital gains. What if there's a way we could put that in a special trust where you still control it, okay, and then we sell the property and not pay the capital gains tax, and we are able to provide a lifetime income for you and your wife? Does that make sense?
Yeah.
I didn't say anything about a charitable remainder trust, but I just explained to you why people might consider a charitable remainder trust, because we can accomplish all of those things. Now, am I helping you solve a problem? Good chance, especially if you've been thinking about selling that property for a long time, but the reason you haven't was because of the capital gains tax. So we got a fantastic situation of being able to help you solve a problem, i.e., get rid of that property without paying capital gains tax. Now, another neat thing about that is if you look at this, not only do you escape the capital gains tax, but you also create, in this particular case, John and Mary, 67 and 65, $1 million property, they create an income tax deduction of $352,000. So stop for a moment here and look at just the numbers. We've eliminated a capital gains. In this particular case, we've eliminated capital gains of $225,000. These are real dollars, okay? We have eliminated a tax of $225. And we've created a deduction of $352,000. Those are really pretty powerful numbers. And as Peter said, that most people are philanthropically inclined before they go into this. I can tell you as a fact, there are several people over the years that I've been working at, they weren't necessarily philanthropic to begin with, but when they saw the benefit, they say, well, wait a second, so I can do this thing, not pay the capital gains tax, get an income for the rest of my life, and get an income tax deduction? And the answer is yes, yes, yes. Really, a lot of people say, well, the loser is the government. No, because as I said before, if you have a choice of the Laguna Canyon Foundation, the hospital, the university, the church, my goodness, they're doing all wonderful things. Yeah. Okay, they really are.
And the government looks at, they encourage this kind of giving, and the reason for that is, if you send $1 to D.C., and you ask Washington to help you fund a program back home, it's kind of like 50 cents on the dollar. Yeah. Versus giving it directly to a local charity where you have probably 80 to 90 cents working on the dollar. So Congress, and all of these are laws, and they're kind of unique to the United States that encourages philanthropy. But you have to make a conscious choice. Mm-hmm. The government is if you don't make a choice, then it's going to be the government. And most people don't understand the tax system. Yeah, they don't understand the tax system, nor do they understand some of the things that we're talking about here. This is all, I would assume, pretty brand new to you. This is overwhelming at times, and that's why I'm trying to keep it as simple as possible in a very complex arena. We got two questions over here. That's good. You guys got to come up here. Yes, you had a question?
What if the property is in another state? Does that come
Not a problem. The issues that where it's located is not a problem. Some of the issues that we run into, and there are, I mean, let's face it, this is very technical, very involved. Debt can be an issue. It is an issue. So we have to look at how do we get around the debt. And let me tell you this, if the property is upside down, don't think of it. So so debt is a concern as to because of the rules and the regulations, and I don't want to go into the detail.
Don't try to donate timeshares.
But we can't go into, at this point, we can't go into all of the what you can, what you can't. I would say when this thing kind of drips down, like it percolates and say, oh golly gee, give either Peter or I a call and say, I just remember we have this, whatever it is, okay? But the timeshares certainly aren't. The Maserati, okay? The 1937 Maserati that's just been gathering dust and it's worth, $2.5 million. Those types of assets can work. They have a Maserati. I just saw them. But whatever comes into your mind, say, well, wait a second, I have this. Will it work here? I don't know, but ask. The worst that can happen is say, oh no, that's
you can fund a charitable gift annuity with a piece of artwork, with a unique instrument, anything that's of value.
Yeah, so now again, we're staying in this arena right now of the charitable remainder trust. What distinguishes it? What are some of the things that distinguish it from the gift annuity? The complexity factor, as I said before, gift annuity, relatively simple. Trust, complex. Control. For those people that I have met over my life who have been very, very successful in their business, they're control freaks. They don't like to give up, and I don't blame them because they have been successful because of that. Well, where a gift annuity is the contractual arrangement between the donor and the charity, what happens here is that you really aren't making a gift to a charity. You're creating a trust. You've had an education already on trust. This is just another trust. What happens is that when you create that trust, just like, you erased it. What's one of the things that you have to have in a trust in order to determine who does what and everything? That is called a trust. A trust. Come on, help me out. Trustee. Okay. You got to get a person who's going to say, okay, I'm going to do thus and so because this is what it says to do. Well, golly gee, you could be your own trustee. So, even though the asset has transferred from your hands into this charitable trust, right there, okay? That's a separate legal entity at this point in time. It's a separate legal entity. It's a trust. It needs to have a trustee. It has to have instructions as to what it can do, what it can't do, what it's supposed to do. Well, what it's supposed to do, there's two main things that it's supposed to do. Provide income for the income beneficiaries, which could be you and your wife, and it could also include your children. Oh, I didn't know that. It's interesting. So a lot of additional add-on. It's like when you buy a car, okay? You buy the regular car and say, well, could I add that on? Yes, you can. Does it cost? Yes, it does. So what is the cost of adding children? Well, you have some considerations that you are making a gift to them. So you might have gift tax. You might have estate tax. The point is that you can do it, but like anything else, you just want to know what are the ramifications. And as Peter said, with some of the more. I shouldn't say just the wealthy people. A lot of people are concerned about how their children are going to use assets when they pass on. They like the idea of having that instead of one lump sum where they can buy that $250 million or that $2.5 million Ferrari from these people back there, or the Maserati. They like to have income. So you can control through this trust that at the end of your lifetime and your wife's lifetime, that income continue on. So it could go for the lifetime of the children. Or you could say, after we're dead, we'll let it go for another 10 years. So children get income. Now, you might also want to overlay this on other types of distributions that they're going to be receiving. But for that one asset, that thing that's just been sitting out there and gaining value, and the only reason you haven't sold it because it's the capital gains, this could very well be a perfect way. So the control factor, the flexibility factor. Now here's the one thing that I hate to say. I hate to say that. You also control who receives it. The charity. Because see, you are creating this thing. You don't have a contractual arrangement with the charity. You go to your attorney, and he or she draws up everything, and you say, I'm going to name A, B, and C as the charities. A, B, and C may never know about it until you pass on to glory. And then they get a call from the attorney and say, by the way, you were named as a beneficiary. So you control basically the assets itself, because if you're the trustee and you've got this building and then you put it in the trust, you then sell the building. What do you have there now? You have cash. Well, it has to be invested. Now, you yourself may not feel comfortable, but you know people that have the expertise to be able to say, okay, for this particular asset now in this trust, you probably would be better served by a portfolio of this, this, and this, right? But you're still in the seat. You're still controlling how it's going to be used. So one thing about the charitable remainder trust, flexibility, control. And those are big, big things. You don't have that with the gift annuity, all right? But they both look the same from the outside. Transfer assets, receive income, at death, asset goes to charity. So they look the same, but there's a whole lot different stuff happening. Now, in the arena of charitable remainder trust, we have two families. We have the living unit trust, which is the one that I talked about, and we have the charitable annuity trust. What's the difference between the two? Well, again, we get into fine-tuning here because they'll both do the same thing as far as taking that asset, being able to put it in there, sell it, and not pay capital gains tax. However, with the unit trust, what's going to happen is that every year the asset is going to be recalculated in terms of the value of that asset. And let's just assume that the payout rate that you've selected is 5%. Every year that asset is going to be recalculated. And let's assume that you've been very, very good in terms of your investments, and the investments actually earned 6% total return. Trust has to pay out 5%, earned 6%. What happens? You've got a little bit more money in the pot at the end of the year. So at the beginning of the year, you recalculate what is in the trust, and you get 5% of that new value. So if you're an astute investor, if you put you got a good portfolio, and it's increasing in value, you're going to have increasing income. Conversely, if you've been a dud, and instead of earning 5%, it's earned 3%, the assets in the trust are going to go down, and you're going to be getting less income. Well, some people say, I don't like that idea. I like the idea of receiving the income, but I would like to have it paid out no matter what. That's the annuity trust. So in this whole family of charitable trust, we have the unit trust, which has the variableness, and we have an annuity trust over here, which is, I'm going to get whatever the dollar amount is, I'm going to get that year in, year out. Now, are there any guarantees? Because in the annuity trust, let's say we've had a horrible investment, whatever, and it was in relatively safe investments. And 10 years down the road, that $5 million is no longer there. The trust doesn't have anything to pay. So you have to keep in mind that where in the gift annuity, it was a contractual obligation on behalf of the charity to pay that. We don't have that. So management is crucial to a charitable remainder trust. So you're looking at this over a long period of time. It's funny because I've had people say, well, gee, if I can do this, can I have any kind of payout rate? There are certain rules and regulations in terms of what IRS says you can do. And in some cases that people could legally, according to the IRS, have, say, a 10 or 12% payout. And they'll say, well, gee, I want to go for as much as I can. Well, let's just step back for a moment. What is the current environment as far as investments? Where in the world are you going to get 12% safely? So you have to look at these things not in terms of, well, what can I get? But what is reasonable? In this current environment, if I want to have 12% and I know that it's probably going to drop down in value, I may not like that because then I'm going to have less money 10 years from now. But if I can say, well, I'm going to be a little bit more conservative in my estimates right now in terms of I'll take a 5% payout with the hope that the investments will earn more than that.